Welcome to today's webcast, Financial Analysis, Finding the Facts to Support Risk Components Assessments. Before we begin, I'd like to cover a few housekeeping items. A copy of today's presentation can be obtained by submitting a request to reply@riskreg.com. To ask a question during the meeting, type your inquiry into the Q&A panel to the right of your screen. We will respond to all questions after the session unless time permits at the end of the session. To respond to polling questions, click on the radio button to the left of your desired response, then click Submit to record your response. For technical assistance, click the Help widget at the bottom of your screen. Today's presentation will be recorded. Cre Eligibility. Log into the webcast with your first and last name and email address. Remain on the webcast for a minimum of 50 minutes. Participate in the polling questions. To answer a polling question, click on the radio button to the left of your desired response and click Submit to record your answer. You do not need to have the correct answer, but you must participate to receive credit. Complete the course participation survey located in the resource list to the right of your screen. For attendees participating in a group, designate one proctor to log in as an individual on behalf of the group. Then complete and submit the group sign-in form within 24 hours of the event's conclusion. The form can be downloaded from the resource list on the right of your screen. Complete and submit the course participation survey. The form can be accessed from the resource list to the right of your screen. 1 CRE credit will be issued to eligible participants within 30 days. RRC will not issue credit if all criteria are not met without exception. It is now my pleasure to turn the call over to Jennifer Kelly. Jennifer,
thank you, Allison. Our first presenter is Neil Miller. Neil is a senior manager at RRC with over 27 years of experience in insurance financial regulation with a focus on insurer solvency. He serves as RRC's lead financial analyst and focuses on analyst training and development, financial analysis preparation and supervision, complex transactions, special investigations, and challenging solvency situations. Our second presenter is Robin Brown, who is a supervising examiner at RRC with over 12 years of experience in insurance regulation, including both analysis and examination. She focuses on financial analysis preparation and supervision, including supplemental filings, analysis of holding company registration statements and related party transactions, coordinating with examiners and actuarial specialists, and analyst training and development. Due to some technical difficulties, Robin will be joining us via audio today. I'm now going to turn this presentation over to Robin. Robin?
Thank you, Jennifer. I would like to begin by thanking everyone for attending our webcast today. I hope everyone finds this webcast informative and beneficial. And of course, please let us know if you have any questions. Now let's begin by taking a look at our objectives. Our objectives today include providing a recap on how we identify risk and focus our analysis efforts on key branded risk components. Additionally, we want to help identify key sources of facts which support the analysis of those key risk components. Some of the topics we will cover in today's presentation will include an overview of the risk analysis process, along with an understanding of how to transform information into robust analysis. An example of this is shown on the slide. As you're aware, credit risk involves the collectability of certain receivable accounts on the balance sheet. In this particular example, we identified a key risk component of credit risk to be reinsurance recoverability. To help us understand this component, this risk in our analysis, we need to find the facts by first identifying material reinsurers, assess their creditworthiness. This identification and assessment will help us understand the true credit risk related to reinsurance recoverables. And this brings us to our first polling question. With more experience with risk-focused analysis, has it become easier for you to identify sources of information needed to make fact-based assessments? A, yes. B, no. C, generally yes, but I can improve. Again, please be sure to provide and submit your response. Please provide your response by selecting the radio button next to your selection and then submit your response. As discussed, participation in these polling questions is a required component to receive credit for attending today's webcast. And we'll give everyone just a few more minutes to respond. Okay, we've got over 80% responding, so. Okay, stop there. Okay, yes. So, well, that's what we hope. Generally, yes, but I can approve as the majority. Plus, yes, so that's great. So we have a lot of good analysts in our webcast today. Okay, now we'll provide a brief overview of the risk-focused financial analysis process. As analysts, we have a lot of information available to us from the company, the NAIC, and other sources. We acquire this information, and after we go through this and review it in detail, that's our analysis. We go through and understanding the information collected. And our question is, how do we transform all of this information into a robust analysis? So this slide depicts how the analysis process works. There's a lot of components that go into the analysis. They include annual statements, quarterly statements, management discussion and analysis, holding company statements and SEC filings is available, and a lot more information we collect. Additionally, your own knowledge of the company and communications, conversations you've had with members of management. All of this comes during the analysis process. And as an analyst, your job is to assess all of this information. You have to understand the risk associated with this information. And when you're done, you have the blended risk assessments that are in each of the risk assessments in the raw and IPS. And I just wanted to share this with you also. We found it helpful when we assess the company's financial condition, profitability, liquidity, and major challenges. That helps us draw a conclusion, or the overall conclusion of the company. So first we'll start with financial condition. The first section or item you want to look at is what kind of capital does the company have? What's its RBC ratio? In general, is the company in sound or less than sound financial condition? Then you assess the recent and prospective profitability of the company. How has it done in the past? Is it making a reasonable profit? What is driving the profit? Is it underwriting results or investment income, or a combination of the two? Next, with liquidity, we consider the liquidity position of the company. Oh, I skipped over that one. Okay, I'm sorry. The liquidity position of the company. Are there any concerns with future cash flow or liquidity? Does it have the ability to adapt in less than optimal situations? And finally, what are the major challenges the company faces? Are they exposed to catastrophes? Do they have restructuring going on? Or what is going on that is significant to the company that could ultimately impact the risk categories? And just an important takeaway from this slide, too, is with the risk-focused analysis process, it's the role of the analyst to review all of this information given to us and decipher the most critical risks the company is facing. And then we are at our second polling question. Which NAIC tools help your analyses the most? A, risk repository. B, company profile. C, FAST, financial analysis solvency tools. D, company summary. E, all used together. And S, other. So I'll give you a couple of seconds to provide your response. Okay, good. We've got over 88 responses, 88% of the responses now. So let's see. Okay, all used together. That's basically what we were expecting as well. All the tools, help the analysis the most, and it's hard to just pick out which one does it because of all the different risks there. Let's see. And then let me shift here. Okay, now let's shift our attention to finding and using. Oh, I'm sorry. This is last year. Okay, identifying key risk components. And this is we've seen this challenging for a lot of analysts that we've worked with and ourselves too. So I'm going to send it over to Neil to assist us in identifying key risk components. Neil?
Well, thank you, Robin. And that was a really great introduction to where we are on this process. So thank you. So whenever we train new analysts, we really like to start with the concept of we have the 9 branded risks, but within each of those branded risks, which components should the analyst look at? What should they consider? And typically in that training, what we'll do is ask them to read a couple of documents to start getting a feel for why companies have failed in the past. And that, to us, a really good foundation to understand which components should be looked at in a risk-focused analysis process. So we usually give them the failed promises report, which is a report on an investigation that was conducted by a committee of the House of Representatives back in the 1980s, with a report issued in February of 1990 that really talked about 2 things. It looked at the ability of state insurance regulators at that time to detect and prevent insurance insolvencies. And in that component, they found that the regulatory process was really sorely lacking. The regulators at that time really didn't have the processes in place to actually do the job that we're doing today. And the second thing they did, and that's really great for us to understand risk components, is they actually did a lot of case studies in that report about some of the large insurance insolvencies that happened in the 1980s. And so when you read that, you'll find out that there's a lot of causes that were identified, like reinsurers that didn't pay their obligations when due, or reserves that were inadequate, or inadequate pricing, or investments that were lost. So there's a link at the bottom of the slide that'll point you to that report. I suggest you can just Google it and you'll get to the same place. We also suggest you read the Troubled Company Handbook, which that's your peers reaching out to you and saying, hey, this is the reasons companies have had financial issues in the past, and pointing you to ways that you might address those issues. So when you read those, and you also look at the other documents we list there, but when you start to look at that, you see in the box to the right some of the top causes of insurance insolvency. For example, investment problems. I invested in bonds and it turned out that I didn't receive the principal and or interest. Or I had some reinsurers and they didn't pay the amounts due, for example, when I had a catastrophe. Or my affiliates didn't pay amounts due to me. Or if you go down that list, there's a lot of different things that happen. For example, I had inadequate pricing. I had rapid growth that caused me to write more business than I could handle, large catastrophes I wasn't prepared for, that type of thing. And so when you think about those in total there, if you look at the white box that's embedded on the left-hand side big box, it talks about weak governance and risk management processes. And regardless of the root causes of a particular insurance insolvency, for example, if the reinsurer turned out to be a bad credit risk, a lot of those could be avoided or mitigated if the companies had strong corporate governance and effective risk management that would go out and identify the potential risks that a company faced and take steps to try to mitigate that risk or somehow compensate for it. And so that, to me, is the whole premise of our risk-focused analysis process and examination process. It really tries to look at insurers from the perspective of management and look at how they view the company, how they govern the company, and how they manage risk within that entity. So when you look at the risk-focused analysis process, just like the examination process, it's really broken up into the 9 branded risks. For example, credit risk. You have a receivable from some entity. Will you receive it or not? Or liquidity risk. Will I have enough assets available to turn into cash if and when needed? And is the cash flow from my operation sufficient to replenish liquidity? I think we're all familiar with those branded risks. But the question then would be, how do the causes of insurer problems in the past, how might they fit into the branded risk categories? And this is an area I think that the NAIC's risk-focused analysis process does a really good job of doing and focusing your efforts as an analyst and my efforts on the root causes of insurance solvency. For example, under credit risk, and again, you have the overriding concept of effective governance and risk management, but in terms of insurance solvency under credit risk, problems with investments, which is really focused on the credit component of investments. For example, the bond, is that a good credit risk? Will you receive the principal and interest? Or reinsurance solvency. Who are my reinsurers? Are they good credit risks? Have there been issues in the past with collectability, and do I expect issues in the future? Or uncollected receivables. Typically, one of the largest receivables on the balance sheet is agents' balances or premiums receivable, but there's also companies that have huge intercompany receivables and other receivables that if you identify those as significant, you would think about looking at. So what we've done on this slide is just mapped the causes of an insurer insolvency to the branded risk. But on the last box on the right, what we've done is said, all right, so understanding that there's causes out there for insurer problems, what risk components would we think about assessing on any analysis in order to make sure that we've captured within our consideration the root causes of insurer problems? In other words, we're focusing our efforts on the areas where companies in the past have had financial difficulty, and our company may be susceptible to that. So, for example, in credit risk, we would take a look typically at the bond portfolio and assess the type of credit risk that it presents to the company. For example, what are the components of the bond portfolio? Is it mostly full faith and credit U.S. government securities, or are they the type of securities that would tend to present a more enhanced credit risk, particularly in times of financial difficulty? For example, asset-backed securities like RMBS, CMBS, and other asset-backed securities, or, for example, special revenue obligations issued by a municipality that are backed by a specific revenue stream, for example, a toll road or student housing, and not necessarily backed by the full faith and credit of the local jurisdiction or the state or the U.S. When we look at liquidity, the risk we tend to look at on every company would be, what is the liquidity position? What cash do they have? What level of cash? What other assets do they have that are liquid? Are there any restrictions on those? For example, have they been pledged as collateral or something like that? Or are they likely to be pledged? And we'd also look at the cash flow from operations, which to me is a very powerful tool, the first third of the cash flow statement, which shows you, what the sources of cash are and uses of cash are from normal operations of the company. And typically, if that's a positive number, it's a fairly good indication that the company is operating profitably. Not always, but if it's negative, that's usually a good indication that the company is operating unprofitably long term. So when you look at these components that you typically assess, again, they line up fairly well with the root causes of an insurer insolvency. And so like on the next slide, I'm sorry, I'm used to scrolling and not clicking. You can see, for example, in pricing and underwriting, the root causes might be inadequate pricing, rapid growth, or growth in a jurisdiction or an area that you're just not capable of properly writing that business, or catastrophes, exposure to catastrophes, and whether or not that's priced into your products and your underwriting process. And so the risk components you would look at in that case would be typically pricing and underwriting. And another example would be reserving. You tend to always look at the adequacy of the reserves, the actuary opinion, the actuary opinion summary, maybe even the risk, the reserving memos beyond that, or report beyond that. But you also look at reserve development and see if there's evidence that, in fact, the company has been conservative in its reserving in the past. So again, each of these can be thought of as a significant component that gets back to what Robin was talking about. Whenever you do an assessment, an overall assessment of the company, you want to take a look at the financial condition, its profitability or lack thereof, its liquidity, and the major challenge that it's facing, including things like risk to catastrophe or growth in new areas or something like that, competition, whatever those major challenges are, which tend to come to light through your branded risk assessments. And as I mentioned a little bit earlier, and I think this is really true, and it's where I think that the NAIC process is really powerful, is when you look at the risk repositories, and this is kind of a snapshot. I had to snip it a little bit to make it legible, but of the overall company summary that you get out, the recap of all the branded risk categories in which positive or yes answers that you get in there. And you can see, looking at the components of that it's very much in line with what I was just talking about. For example, in credit risk, a lot of these components are driving you right to the credit risk that's embedded in the significant investments and how you could view that in terms of the potential for not receiving the principal and interest on those assets, or the reinsurance recoverability under credit risk, or the affiliated receivables or uncollected premiums. And whatever's on the balance sheet that is likely to be a credit risk is typically identified within this branded risk category. The same thing happens in each one of those branded risk categories. And so the whole point of this was to just describe to you why it's so important from my perspective to follow the NAIC process, because it's really geared toward the root causes of insurer insolvency. I would just slide back one more slide and say, when you are setting up your analysis of the company, to me it's very good if you would to follow the risk components generally assessed as laid out on these slides or in the NAIC handbook. I think that typically focus you on the right areas of the company, but I think what's more important is to use your knowledge of the company and your experience and your just logic and say, well, are these the right components, or which one should I look at for this particular company? Basically tailor the analysis to make sure that you are assessing the right risk components for each company. So here's an example of what we're talking about here. So in this case, when you look at credit risk, there's a lot of sources of credit risk for a company. For example, it's investment issuers, the bond issuers, mortgage borrowers, things like that, reinsurance recoverables, hedging counterparties for derivative transactions, corporate insurance, which typically doesn't come up in an analysis, but if I have a risk, for example, of my building burning down, am I going to get recovery from my insurance company for that risk, or workers' compensation insurance, or whatever it is? Risk from banks, including your normal deposits and any other kind of deposits with the bank, affiliated receivables and agent balances. Each of those receivables that you have is a source of credit risk. And so when you look at that and you start doing your preliminary assessment, in this case, reinsurance recoverables pops out as something that looks big to you. It looks important, it's trending, it's negative, whatever, and that might be a risk component that you would open up as part of your credit risk assessment. And the result of your analysis might look something like this, some kind of write-up about the reinsurance recoverability. And if you have an overall assessment, and this is an IPS version of your risk assessment, but typically the results of the assessment that you do for each of the components that you look at, in this case credit risk, show up as part of your overall assessment. For in this example, in this case, we're rating reinsurance recoverability as a moderate concern with an increasing trend, and that's based on the view that the risk of reinsurer default has increased because of the selection of a lower rated reinsurer and an increase in past due premium receivable balances. So with that, Robin, I'll turn it over to you for a moment.
All right, thank you, Neil. So we're to our third polling question, and it is, with more experience with the risk-focused analysis, has it become easier for you to identify the key risk components for your companies? A, yes. B, no. C, generally yes, but I can improve. So we'll give everybody a couple of seconds to answer that.
And Robin, while they're answering, I would just point out one of the questions we got was from an individual who logged in a little bit late and wondered if I missed the first question, would I still receive for full credit? And the answer to that is you have to get 80% of these polling questions answered in order to get credit, so you should be fine.
Yes, thank you. All right, great. It looks like we have about 93% there. All right, it went back to those. Okay, great. C, yes, but I could improve. All right, and then we want to shift our attention to finding and using facts during our analysis. So one of the biggest challenges of the analysis process is being able to take all the information that is readily available and focus on or pull out the pieces of information that is most relevant to our company. So examples of sources that we utilize during the analysis process, obviously we have annual statement, audited financials, but it's also critically important to use information gathered from communications with company management, holding company filings, and from communication with other states. So somewhere in this huge stack of data is the information you need for a particular branded risk. And it's the analyst's job to digest all this information and then pick out the key risks impacting each respective company. And then, Neil, I was going to hand it back over to you for the credit risk example.
Thank you, Robin. Another good introduction. I appreciate it. So in this example, we wanted to continue with the theme of reinsurance recoverability and take a deep dive into how or what facts are available and how we identify them and how we then use that to draw a fact-based conclusion regarding a risk component. So in the little graphic at the bottom, you'll see that that's the typical insurance transaction in the two boxes to the left. So an individual or some business purchases an insurance policy, pays a premium over to the insurance company, who then, in the event that there's some kind of loss, will reimburse the individual for the policy benefits to the extent applicable under the insurance policy. That's basic insurance. Then to the right of that, we introduced the concept of a reinsurer. So in this case, the insurer has some component of risk, for example, an excess of loss on the individual policy, it's too big for me to handle, or exposure to catastrophe that sort of aggregated within the insurance portfolio that you would find you just can't bear that risk. So you're going to ask the reinsurer to accept that risk from you in exchange for paying some or all the premium that you receive over to the reinsurer. And so whenever there is a policy claim on the left side of this, the insurer then can go to the reinsurer and say, well, I've had a loss and I want you to reimburse me for your proportion of that loss under the reinsurance agreement. And so that results in the red box, the credit risk that we talk about with regards to reinsurance. So in this case, and this is an exercise I found particularly helpful to me, which is to step back and just think about all the sources of information that you have about reinsurance recoverability. And so the first thing you look at is, for example, on the asset page on line 16.1, and this is all pointed to P&C companies, of course, in 16.1, it shows the asset that's recoverable for paid losses, which is typically a small portion of the total amount recoverable from reinsurers, which you can discern from Schedule F, Part 3. There's also, for example, in the notes to financial statement number 23 and 26 provide good information on reinsurance and reinsurance recoverability. General interrogatory number 14 talks about reinsurance. There's information in the 5-year historical data on the company profile, FAD scores, et cetera. And one of the key components, I think, that is really important is the coordination between examinations and analysis. So when you, for example, are beginning your assessment of reinsurance recoverability, you can talk to the examination team, look at the examination report, look at the SRM, look at the work papers that were created in the examination, and see if that provides the information you're looking for. And on the back end of that, as you're conducting your analysis, as you're conducting your analysis, you can actually use your examiners to help drive the process even further. So you could point out, holes in your knowledge about the company or issues that you have about the company, and have the examiners do a deeper dive into that on your behalf. So let's take an example, walk it through. So we have, in this case, a company that writes $300 million in annual direct premiums. They cede 100% of all the new business that was written. And I said it that way because the business before 2016 was retained by the company, so you'll see some reserves sitting out there, some on the books of the company, but all new business is 100% ceded. And there's one primary insurer involved. It's an affiliated insurer, and it turns out to be an authorized reinsurer. There's also another affiliated reinsurer in this case that's an alien certified reinsurer. So that company has a smaller piece of the reinsurance pie. And there's, in addition to the two affiliated reinsurers, there are many other reinsurers for specific risks. And that includes alien insurers, certified, unauthorized reinsurers, et cetera, that are picking up, for example, on a facultative basis, some of the insurance risk on behalf of the company before it cedes to its primary reinsurance affiliate. So as we start looking through for information, I'd like to start with the management's discussion and analysis. And if you were to read through this, you would see that it provides an overview of the reinsurance program. In this case, I think it's rather sufficient because of the 100% cession. I usually like to get more information than I'm getting from this MD&A, but it's a good place to start. Some companies are better in its description than others. But there's really little information regarding credit risk in the MD&A. It really doesn't talk about the affiliated and unaffiliated reinsurers and what credit risk they pose. And again, we're just focusing here on credit risk. We're not focusing on this risk component on the adequacy of the reinsurance program or how it protects the company. So I didn't try to squeeze all 76 or whatever it is columns of Schedule F Part 3 onto the slide. Even with just one snapshot, it's hard to read. But the key takeaways here are that there was $300 million of ceded premiums spread out amongst the various reinsurers this year, and in the past, other reinsurers that aren't being used this year. So you can get a feel for who the reinsurers are, who the big ones are in the current program. You can also take a look at to the right-hand side that there's $1.2 billion in net amounts recoverable from the reinsurers, typically from the companies that are in the current program, but some that are no longer being used for current reinsurance. And you can easily pick out the large affiliated reinsurer with the $894 million net amount recoverable. Then if you jump to the annual statement and jump to note 23, in this case it shows you that who the largest reinsurers are, that there's no amounts in dispute that are significant to the reinsurer, et cetera. So it gives you a little bit more on the credit amount. Then if you look at the company profile, one of the great tools that the NAIC has out there for us to use, it confirms the largest reinsurer. It helps you to focus your attention on the large main reinsurers, but it really doesn't assess the credit risk. It just helps you to stratify in terms of significance. And if you look through the risk repository, in total, what this points out to me is there's generally no significant risk items identified by the reinsurance recoverable risk repository components. It does highlight that alien reinsurer that's a certified reinsurer and affiliate, and it turns out that that's a relatively sound reinsurer, but the risk repository doesn't really point that out to you. That doesn't really assess the credit risk associated with that. In the next slide, you can see it highlights that affiliated alien reinsurer. But again, it doesn't really tell you much about credit risk. So another good source for reinsurance recoverability is the actuarial opinion, because not only does the actuary focus on the gross reserves, it focuses on the net reserves, and as part of that assessment, the actuary typically looks at the quality of reinsurers, either does it look at itself or ask management about their assessment of reinsurance collectability. And in this case, the actuary points out that the majority of reinsurance recoverables are from companies with secure ratings or for whom the reinsurance recoverable is fully collateralized. The FAST scores, there's PA4, which again focuses just on that kind of minor piece that's on the balance sheet, but it questions whether how much is the recoverability of unaffiliated reinsurance on paid losses and LAE to policyholder surplus, and in this case, there's pointing out no concerns. There's another FAST score that has a subcomponent of it related to reinsurance recoverability on paid losses. This particular FAST score, PA14, is generating 50 points, but when you digest what the components are, you realize that most of that 50 points is being generated from item B, the investments in parent subsidiaries and affiliates, not the reinsurance recoverable. Another thing you do is instead of looking inwards at the ratings for your company, if you look outwards at the ratings for the reinsurers, you can get a real good feel for their credit perception, at least from the view of the rating agencies. In this case, the largest reinsurer was a single A or an A+ rated company. It's been rated A+ for forever, it seems, and that's actually a group rating for this group, but it turns out that the whole group is financially secure, again, at least in AM Best's viewpoint. Another good source would be the audited financial statements, where it provides, again, a high-level overview of the reinsurance program, and it notes that management monitors the financial condition, risk concentrations, and economic characteristics of its reinsurers to lessen the risk of default. Again, this is an area that is ripe for working with management or working with your examiners to really get a better feel, a deeper feel for how management actually selects and monitors its reinsurers and manages the reinsurance credit risk. But at least this is some indication directionally of the process that should be in place. Continuing with the audited financial statements, they point out the largest reinsurers or the ones with the largest reinsurance recoverable, And in addition, at the very bottom, you can see that the company didn't write off any reinsurance recoverable balances in the last 2 years, which again is another indication that management believes that credit risk is not significant related to reinsurance. So when you take all those together and do your facts-based assessment, in this case, you might conclude that management monitors the financial condition, risk concentrations, and economic characteristics of its reinsurers to lessen the risk of default. The majority of reinsurance recoverables are from companies with secure ratings or fully collateralized. The reinsurance recoverables are $1.2 billion, of which almost $900 million relate to that affiliated authorized reinsurer that's rated A+ by AM Best. And the company has no history of reinsurance defaults and wrote off nothing in the last year. So in my view, this would end up being like a minimal concern with a static trend. You might view it differently, but in my mind, looking at maybe some more facts that I've presented here, but it just in total, I think this is a minimal concern. So again, a really good exercise, if we go back several slides, to making a list of where you find these facts and develop your own go-to risk information source list so that you can be sure to include these various components in your risk assessment. So clicking too fastly, we want to walk through another example, which is the reserve adequacy and reserve development, which can be viewed separately as separate risk components. For example, the reserve adequacy really talks about the current reserve assessment that's done by the actuaries, either the appointed actuary, or if your department has internal actuaries, their view of the world, or the reserve development, which is Schedule P and the other indications of the adequacy of reserves. But we're going to look at those as one for this example. So again, there's a ton of sources out there to consider when you're looking at reserve adequacy and development. Again, you look at the liability page right off the bat to see how much the net reserving is on the books. Notes the financial statements, particularly Note 25 for P&C companies, gives some really good insight into the reserving. The 5-year historical data points to reserve development and deficiencies. The company profile highlights things, et cetera. The key things here, in my mind, are the Schedule P, Parts 1, 2, 3, and 4, the actuarial opinions and the related summaries and reports. And again, the examination team, which goes out and takes a deep dive into the reserving practices. And again, can be used to focus energies on sort of the key problems or key issues that you want focused on as an analyst as part of the exam. So the same company, $300 million in annual premiums, 100% cession. The gross reserves are $1.2 billion, and the net reserves, again, this is all business from 2015 and before, were $17.8 million. So again, you look at the MD&A first because that really gives you a good starting point on reserving. And in this case, the MD&A highlights issues with the gross reserve development. In this case, the company had a gross reserve development of adverse development of $58.9 million, which really calls into question the adequacy of the reserving practices and the conservativeness with which the company reserves in. The impact to the company on a net basis is almost negligible or zero because of the 100% cession of all new business. Of course, in the event of the default of the company, or the reinsurer, which we've already considered in credit risk, that those losses could come back to our company. And another nice thing is they disclosed a kind of a current assessment or disclosure is that there was some pandemic losses on the gross losses. So this particular company had $119 million of incurred losses, principally from event postponement or cancellation policies they wrote. So again, my go-to note for any reserve analysis is Note 25, which in this case points out that there was $700,000 of favorable net reserves and highlights again that $58.9 million of gross adverse development. So again, it points out that the company is not terribly impacted by reserve development on a net basis, but on a gross basis, it's fairly significant. You could also take a look at Schedule P Part 2, which in this case shows $176,000 of favorable net development. And you'll see that the net development, those numbers differ from source of information to source of information. I'm not quite sure. I wasn't able to figure that out, but the overall impact is negligible. But again, the gross adverse development, it's not highlighted in columns 11 and 12 in the schedule, but you really could go back and compute it if you wanted to off Schedule P. The company profile shows the 1 and 2 year reserve development. You can see the same numbers that you would see on Schedule P because that's where the numbers are coming from. And the risk repository, when you roll through that, since the net reserves are immaterial, adverse net development would likely not materially impact this company. It's sort of one of the takeaways I've got. And also, reserve development has fluctuated, but again, has been immaterial on a net basis. So you can see on this page, it shows some of the, one of the factors is whether or not a company is writing short-tailed or long-tailed lines of business. In this case, most of the business seems to be short-tailed, which typically those losses develop fully within a couple of years, and you really don't have as much of a risk of adverse development as a company that's more focused on long-tail or more volatile lines of business. And this snippet of the risk repository shows the reserve development, pretty much the same information that we've seen in Schedule P, and you would see on the 5-year history, et cetera. The Actuary Opinion, of course, is really the mother lode for information. And in this case, the actuary opined that the carried gross and net reserves are reasonable, and the amounts in the opinion agree with the annual statement. Of course, they say they're reasonable, but on the gross basis last year, they also said they were reasonable, and it turned out that they were almost $60 million deficient. So that's a piece of information to consider. They also point out, and I think this is a really good source for understanding sources of volatility in the insurance business. In this case, because of excess liability policies, COVID-19 related claims, and personal accident insurance policies that create the presence of those factors creates uncertainty in the reserves. And that's just another piece of the actuarial opinion that again points out in the top of this the sources of uncertainty regarding the reserving. The actuarial opinion has this recap of the reserves that were being certified. You can tie this right to the annual statement and make sure that apples and apples are being compared. The FAST scores on this, PA 19 and 20, raise no concern. So that's a look at the loss and LA reserves to policyholder surplus because it's on a net basis. Again, that's a relatively minor piece to the total financial condition of the company. And the 2-year reserve development, again, no issues being raised there. And IRIS ratios 11, 12, and 13 raise no concerns about the reserving. And that's looking at the 1 and 2 year reserve development and estimated current reserve deficiency to policyholder surplus. The audited financial statements I found to be a really good source of information regarding reserving, particularly with the inclusion of things like the schedule, where if you look in the middle of it, you can see that they show the incurred amounts this year, not just for current year business, but the prior year business. In other words, how much did the prior year reserves develop? And in this case, you can see the negative or the adverse $594,000 development. Again, this is a number that doesn't quite tie in. I'm not sure why, but there you go. The audited financial statements also talks about, cites the reason for the favorable development and pandemic impacts. and it discloses the pandemic losses. I don't recall in the audit financial statement seeing much discussion on the gross reserve development, so that maybe a deficiency on that. But when you pull all this information together and you take a look at that, you would determine that, for example, that since 2016, all new business has been ceded. As a result, reserves were only $17.8 million, all related to 2015 and before. The appointed actuary issued a reasonable opinion on the reserves. However, the actuary noted that there's volatility present from certain factors, and in this regard, the net reserve development has been minimal, but significant adverse development of $58.9 million was noted on the gross reserves. And while the company is largely protected from adverse development by reinsurance, it calls into question the adequacy of the current carried reserves. So I viewed this as a minimum concern, mostly because of the net carried reserves, but with an increasing trend because you still have to get it right on a gross basis. So Robin.
Thank you, Neil. We're down to our fourth of 6 polling questions. So number 4 is, which information source do you find most beneficial? A, insurer filings. B, management representations and explanations. C, NAIC tools. D, rating agencies. Or E, other. We'll give everyone some more time to respond. All right, let's go to, okay, it looks like C, NAIC tools. So that's great. I mean, everything we kind of put together, that's really what we go back to for our analysis. Okay, we wanted to share some current trends and topics we've seen come up lately in our analysis, and it'll be really interesting to see if you have seen any other recent areas of development. We've seen there's been an increased use of the Medicare Advantage audits from the U.S. Office of Personnel Management. As an analyst, it's important to understand these audits are occurring and any potential impact this may have on your company. And then also another thing we've seen recently is Medicaid Callbacks. And as a result of COVID-19, there's been a pressure on states to look for additional sources of revenue. Forecasting tax revenue lately has become less predictable. And then this slide has got a lot going on there, but we are seeing a lot of catastrophe-type claims. Recent examples include an active tropical season in the North Atlantic Basin, wildfires in the West, tornado activity throughout the U.S., and more recently, flooding in central Tennessee. But the interesting thing here is all of these catastrophes is not limited to one geographic part of the country. It seems like every region is being faced with catastrophic-type claims. And then another hot topic, and we've seen this brought up by the NAIC as well, is they're taking a look at credit scores and the impact that has had on consumers' ability to obtain fairly priced insurance. So we just wanted to include that there. And then more on the focus of use of credit scores. And then I want to get to the 6th polling question. With more experience with risk-focused analyses, has it become easier for you to identify the facts needed to fully assess key risk components? A, yes. B, no. C, generally yes, but I can improve. And again, this is the 5th and final polling question. All right, we'll just give everyone just a few more seconds. Okay, great. Yes, generally yes, but I can improve. That's great there. And that's the end of our polling questions. I want to turn it back over to Neil. I kind of went through interesting things we've seen lately pretty quickly, but is there anything else that you would like to add?
And thank you, Robin. And just one more thing. We showed a couple slides with a lot of sources of information for that the analysts can identify and use to make a fact-based assessment of these risks. I would just encourage the new and developing analysts on this phone to take time during the next month or so as they're going through their analysis and just start making their own tool, their own go-to list of these factors so that they can be sure to use them on their risk assessments. So thank you. I think time for a question or two, or if there's any questions that we didn't have the ability to get to, we'll just go ahead and respond to the person who wrote the question in writing. And we do have one question. What was the address to request of the copy of the slides today? And Allison, maybe you have that information.
I will reply to that with the email address.
Okay, great. I just wanted to bring it to this slide, and we have one more slide of image sources and acknowledgments. But on behalf of Neil and myself, I really want to thank everyone for joining us today. It's great. We learn a lot from all the analysts we work with, and we just would like to share, anything we have. But this is our contact information, and of course, it'll be on the slides if you request them as well. And then just our image sources and acknowledgments we wanted to include here. And I believe we might be ready for the closing remarks, Allison.
Okay, a few reminders before we conclude. Please take a moment to complete the attendee survey by following the link in the resource list to the right of your screen. We will respond to any additional questions via email following today's event. We appreciate you joining us today, and thank you for participating in today's program.